In 2025, one of the biggest financial debates isn't about stocks or crypto, it's about your home. Should you still pay off your mortgage early? Or is that money better invested elsewhere? With interest rates, inflation, and housing prices all fluctuating, even experts can't agree on the right answer. What once seemed like a clear path to financial freedom now depends on personal circumstances and market dynamics. Let's break down the new logic behind this timeless question and explore why opinions are more divided than ever. 10. The emotional value of being debt-free. For many homeowners, the biggest appeal of paying off a mortgage isn't financial, it's emotional. Owning your home outright brings peace of mind, security, and a sense of accomplishment. In uncertain economic times, knowing you'll never lose your roof to rising rates or missed payments provides comfort. Even if the math sometimes favors investing, the psychological benefit of debt-free living can't be measured in percentages. 9. Low fixed rates offer a hidden advantage. Homeowners who locked in historically low rates before recent hikes are in a unique position. Their cheap, fixed debt acts as a financial asset in itself. Paying it off early might eliminate one of the best hedges against inflation available long-term, low-cost borrowing. Instead, investing extra cash in higher-yield assets could generate better returns. Financial advisors often suggest holding on to low-rate mortgages while redirecting funds into retirement accounts or diversified portfolios that outpace interest costs. 8. The inflation factor in 2025. Inflation changes everything about debt. As prices rise, the real value of money owed decreases over time. Essentially, you're paying back your mortgage with cheaper dollars. In this environment, holding debt can actually work in your favor, especially if your income or investment returns grow faster than inflation. Paying off the mortgage early might feel safe, but could cost you the ability to leverage inflation's quiet advantage. It's a counterintuitive but critical piece of the 2025 financial puzzle. 7. The investment opportunity cost. Every extra dollar you put toward your mortgage is one you're not investing elsewhere. Historically, well-balanced portfolios have delivered higher long-term returns than most mortgage interest rates. With new investment vehicles, from dividend-paying stocks to index funds and real estate trusts, your money could potentially grow faster than your debt shrinks. The key is discipline investing those funds consistently instead of letting them sit idle. Missing out on compound growth is a major hidden cost of early payoff decisions. 6. Rising property taxes and maintenance costs. Even after paying off a mortgage, homeowners aren't completely free of housing costs. Property taxes, insurance, and maintenance continue to climb. Inflation has pushed repair and renovation costs to record highs in 2025, eroding the financial benefit of eliminating mortgage payments. Keeping liquidity cash or investments available for these expenses is crucial. Paying off your home early might leave you house-rich but cash-poor, unable to handle large, unexpected costs without dipping into emergency reserves. 5. Flexibility versus stability. Paying off your mortgage early gives stability but sacrifices flexibility. Once that money is tied up in home equity, it's difficult to access without refinancing or selling. In uncertain markets, maintaining a mix of liquid investments can be smarter. Liquidity provides the freedom to pivot, whether it's seizing an investment opportunity or managing a sudden financial setback. Experts often stress that stability is valuable, but flexibility is survival. The ideal approach balances both without overcommitting to one. 4. The role of age and retirement goals. Your stage of life dramatically affects the answer. Younger homeowners may benefit more from investing than from early payoff, as they have time to compound returns. Retirees, or those nearing retirement, however, often prefer eliminating major debts for peace of mind and reduced monthly obligations. The decision ties directly to lifestyle priorities, financial growth, versus guaranteed security. Understanding your long-term goals helps align your mortgage strategy with the life you want after work. 3. The hidden impact of tax deductions. Mortgage interest used to offer strong tax advantages, but recent policy changes have limited those benefits. With higher standard deductions and fewer itemization options, paying off a mortgage no longer produces the same tax trade-offs as before. However, investors can still benefit from directing funds into tax-advantaged accounts like IRAs or Roths instead. This shift makes the purely financial argument for early payoff weaker for many households, especially those who no longer rely on mortgage interest deductions. 2. The risk of overconfidence in markets. While investing can outperform mortgage interest, it's not guaranteed. Market volatility, geopolitical risks, and economic shifts make returns unpredictable. Relying solely on investments to justify keeping a mortgage can backfire if markets underperform. Diversification remains critical. Balancing mortgage debt with conservative holdings provides both growth and protection. Experts emphasize that emotional resilience is as vital as financial logic when navigating uncertain investment climates like those of 2025. 1. The personal balance of logic and comfort. Ultimately, the decision to pay off your mortgage early depends on your comfort with debt and your long-term vision. Financially, the smartest move may be to keep low-interest debt while investing the difference. Emotionally, peace of mind might outweigh potential gains. There's no universal answer, only what fits your situation. In 2025's complex financial landscape, blending practical math with personal priorities leads to the best outcome, ensuring both stability and opportunity coexist. The mortgage payoff debate isn't about right or wrong, it's about balance. Whether you choose freedom from debt or the pursuit of higher returns, understanding your motivations and financial landscape is key. Inflation, interest rates, and opportunity costs all play a role in shaping the smarter choice. If this breakdown helped clarify your next move, tap the like button, share it with someone wrestling with the same decision, and subscribe for more insights that bring clarity to today's complex financial world.